Let's get more insights from Michael Price, the Chief Equity Strategist, Standard Chartered Bank, joins me right here on set. Thank you so much for dropping in. First of all, we've got CPI and a whole host of data points to look at. It's going to be a data fest tomorrow out of China. Prior to that, we get this trade surplus, which is well beyond expectations, regardless of whose projections that you look at. Washington says, China, you need to do something about the currency. But, you know, inflation, the Chinese argument could be it's no longer our issue. It's a worldwide issue. Commodity prices are going up. And another thing, Lian Feng said something recently that the world that we're used to of cheap labor goods, cheap products, no longer will be the same. We're in a completely different dynamic. And ultimately, how do you see this relationship playing out?
I think it will play out for the better of everyone. In the meantime, of course, we're going through a very difficult rebalancing exercise. I mean, these global imbalances have to be resolved, and I think it's about strategic decisions and hard choices. And this is also where Beijing needs to move on the currency sooner or later, but then again, the official view out of Beijing is we're not ready yet. America, of course, wants the currency to be revalued faster. So this is very much the issue. But Chinese economy is very robust.
Let me jump in here.
Hi.
Let me jump in here. I'm just reading through your notes, and you're saying that the silver crude crash that we saw last week is an indication of something more existential to you. What do you mean by that? What could be coming down the line?
I mean, basically, at the moment, we feel that the dollar is rebounding in the second half of the year. And so far, it was a very crowded trade. I mean, basically, it was short US dollars, long risk assets, whether it's equities, commodities, and so forth. And we feel that this potentially could be a trend change. For instance, I mean, our Standard Chartered Bank house view is to be underweight commodities on the 12-month view because we feel that growth is slowing down, not just in Asia, but also across the world, while inflation in many emerging markets is still an issue. So this is actually short-term negative for growth, and most probably the commodity market reaction we saw the last 2 weeks is an indication of what potentially could happen in other asset markets. This is why also our view on equities, on global equities, is neutral on a 3-month view.
Michael, it's Anna in London. That's interesting then in the context of the question I wanted to ask you about the relationship between energy prices and risk assets, and specifically perhaps stocks, because in the US at the moment, when we see a rebound in energy, in the price of energy, we tend to see a rebound in stocks as well, which might be counterintuitive to those who were worrying about inflation a few weeks ago. So when do we start to see a fall in energy prices as a positive?
Well, as you rightly pointed out, the correlation is very high. In many instances, actually close to 0.8 to 0.9. So actually, it is very much about the US dollar weakness. And should the dollar rebound more broadly in the future, then potentially it would have a knock-on effect also on equity markets. This is why, again, we feel that in this environment it's important to be more selective. It's more about single stocks.
I just want to go back to the U.S.-China issue. Initially, when we did get a trade deficit in the first couple of months, and then there were a lot of oohs and ahs, you know, have we switched the perspective on China? Has the dynamic changed, and etc.? But ultimately, was that simply a matter of overstocking in the first initial couple of months to export their way in the latter months, or is China still moving in their own way, but albeit in small steps?
I think they're moving in their own way, and you mentioned it, Mr. Fung, right, saying that yes, China increasingly is focusing on domestic consumption, and also increasingly is actually creating inflation in the world, not deflation. Because you see, while America was doing well, it was okay that China exported deflation across the world. When America went into this terrible deflation because of the subprime crisis, China had to react, and now it's creating inflation in the world. And this is what a lot of Asian countries are feeling. It's not just quantitative easing, it's also the Chinese that somehow are responsible for this inflation in the world because of these. Remember, if you look at $2.7 trillion of worth of foreign exchange reserves, that is also in its own right inflationary.
Yeah, and as they go into a second day of meeting, probably hard to expect the Chinese backing away, and also the same for the U.S. side, given that they both have power transition lined up in just about a year's time. Well, we've got to leave it there. Thank you so much. We appreciate this.
Thank you.
We've got to say goodbye to Michael Price there of Standard Chartered Bank. Appreciate his insight.